Hi, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management. And welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets so you make better decisions in your business and with your investments. Let's start with the highlights. Markets have held up better than expected, but even the pros are struggling to read the tea leaves. And we're seeing signs of a decelerating economy, less hiring, flat earnings, and cautious consumers. That's why the bond market is now pricing in multiple rate cuts this year. And looking ahead, AI investments are surprising to the upside, with more aggressive investments while starting to reshape white-collar industries faster than expected. Now, let's take a deeper look at the data to see what else we can learn. Recent market performance has been positive in stock and bond markets. In June, they've been higher across the board. Now, for the quarter, international stocks continue to be strong, having outperformed everything but the NASDAQ in the quarter. And they are between 10 and 14% higher than the S&P 500 and NASDAQ this year. Now, the bond market's performance continues to improve, with returns up mid-single digits year to date. Now, on the other hand is oil. Oil is down about 10% in the quarter, while the copper and Bitcoin markets have rallied this year. With geopolitical events and changes to trade policies and immigration, even the big Wall Street players like hedge funds are having a rough time this year. Macro funds just had their worst start year to date in 2 decades. In other words, even the pros with access to the best resources are struggling with how to make money in this environment. And it's not just professional investors feeling uncertain, employers are too. Job postings on Indeed.com have been drifting down for over a year now, which is a quiet signal that businesses are pulling back on growth plans and are more cautious. Now, we see this cautiousness in earnings estimates for publicly traded companies. After the drop we saw in April, corporate earnings estimates for 2025 have mostly flattened. Now, Wall Street's basically holding its breath to see how companies actually report in this upcoming quarter. So with investors shaky and hiring slowing, markets are now betting that the Fed's next move is a rate cut. And the decline in the shorter end of the yield curve are investors saying that they see softer growth and more tepid inflation ahead. So the Fed should lower interest rates. Now, weekly activity points to economic growth of around 2% year over year. Yet more recently, it's really decelerated after a spike after April 2nd. And we look at real-time credit card data. Despite the noise, consumers are still spending. Now, the pace of growth is decelerated from a pickup in activity before the tariffs started showing up in prices. In the last few weeks, it's stabilized. But within that, there's a pullback on discretionary items in favor of more essentials, and more value focused by shopping at warehouse stores, which typically favor middle and upper income shoppers. And the credit markets often provide insight into the direction of the economy. Even with the anticipated economic slowdown, the spread of high-yield bonds and investment-grade bonds to the risk-free U.S. government bonds has been steady, and that's signaling that investors believe that the default risk from a weakening economy is not a major risk overall. Now, on the positive side, a key driver of the U.S. economy is that companies are making productivity investments. So think AI. The investments by the largest companies in AI is enormous, and it's accelerating. We're quickly approaching $1 trillion in combined capital expenditures and R&D, with nearly $500 billion of that of CapEx. That's up nearly 5-fold in less than 4 years. And these are the companies that generate ungodly sums of free cash flow. And they're some of the best businesses in history before making these investments, which they consider existential. Now, a big reason for this is the launch of ChatGPT, where the Mag 7, or the largest companies in technology, those profit margins have exploded. So why not fund more AI investments? And while the economy cools, the long-term story is tech, especially AI. And it's mostly white-collar industries that are leaning into AI. So think lawyers, consultants, finance, and professional services, where the work is much more about thinking, not lifting. To sum up everything from today, here are the key takeaways. The market's been strong, but even the pros have been confused. And the economy's slowing. Companies are hiring less, earnings have stalled, and people are spending more carefully. That's why markets expect rate cuts. And looking ahead, the big money is going into AI, especially in white-collar industries. With that, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time with our next edition of The Pulse.